Hey everyone, welcome to Leading Indicator, a show by Public.com, bringing you all the insights from the world's very best macro minds. I'm your host today, JD Durkin. We are with you today to discuss the road ahead for equities and, of course, all of the opportunities within. As always, do not forget to like, comment, and subscribe to our channels for many more in-depth interviews that will help you keep up to date with the latest investment news. Joining me today is a guest I'm very excited to sit down with, Dave Sekera, Chief U.S. Market Strategist at Morningstar. Dave, thanks for being here and welcome to Public.
Oh, of course. Thanks for inviting me onto your show.
So let's talk about today's CPI print, Dave, for the month of June, coming in below estimates, 0.2 monthly increase compared to the expected 0.3% increase. Of course, 3% in June compared with 12 months earlier. So perhaps a bit of relief, a bit of good news, trending perhaps in the right direction. The central bank, as we know, recently halted rate hikes last month after 10 consecutive increases, Dave, going back to March of last year. The overall target rate, as we know, sits between 5 and 5.25% currently. Dave, can investors, you think, expect the Fed here to begin shifting policy after the softer than inflation release? Or is this simply one data point making it too soon to tell? What do you think?
I'm not looking for a shift in policy. We think that there's going to be one more rate hike come here in the next week and a half at the end of July, but we do think it's one and done at this point. Now, the CPI print, we weren't surprised. Inflation has definitely been coming down for a while now. In fact, we have a much more sanguine view on inflation than I think what consensus is. In fact, we actually look for inflation to get down to the Fed's 2% year-over-year run rate by the end of this year. And when we look at inflation going forward, we expect it actually slightly below 2% inflation on average over the course of 2024. So this definitely will take the pressure off the Fed. We don't think that they're going to have to do any more rate hikes for this monetary tightening policy cycle. And, in fact, we do think that the Fed probably beginning of next year, maybe around February, could actually start to cut rates just because we do think inflation will have come down enough. And we are still cautious on the economy. We do think the economy will soften second half of this year. So that combination, softer economy, lower inflation, gives the Fed the room to start cutting interest rates.
So just to reiterate, sounds like your base case here is for the Fed to hold for the next four meetings
Yes.
between now and the end of the year, and then you're expecting the cut cycle or the anticipated Fed pivot, so to speak, to begin in February of 2024. Is that your best bet right now?
Well, we're still looking for the last 25 basis point hike here in the July meeting in the next week and a half. After that, on hold, and then the first cutting maybe as early as next February.
Yeah, well, and we'll get that decision, of course, on July 26th. Talk to me about the overall impacts on the markets. Obviously, as we have this conversation today, a little bit of a relief rally in the day. We were looking for that CPI print, so we're seeing the major averages trade up in the green. But give me your overall view on what the impact on the markets could be to the very spirit, the heart of the conversation we're currently having. What does this mean for the markets?
Well, I do think markets now are also coming to the same view that we have, that inflation is coming down a lot faster than what people had expected, even just a couple of months ago. So again, that now allows the Fed, to take their foot off the economy, really kind of let interest rates at this point, do what they need to do to slow the economy down enough to make sure that we keep long-term inflation and inflation expectations under control. So really at this point, I think the market is really now going to start focusing on earnings. We've got the big mega banks coming out on Friday, a number of the regional banks starting next week. So I think from now on, the real focus is going to be what are earnings and what are they going to look like in third quarter? What kind of guidance are management teams, going to show to the market in the third quarter?
So let's talk about those bank earnings, specifically reduced credit availability or any other potential pressure points. Dave, in your most recent third quarter outlook, you mentioned that reduced credit availability, saying, look, this could really be a factor in market slowdown for the next few quarters. Is that your expectation? And what else will you be following for those bank earnings, which, as we know, really kicks off the heart of earnings season?
Yeah, definitely. When we look at the senior loan officer surveys, they are showing that they are tightening credit standards. So again, there'll be less availability for companies out there to get the borrowing that they want. They're going to have to pay higher interest rates for that borrowing. That will work its way through the economy. So we're actually on an economic point of view looking for sequential growth slowdowns for the next 3 quarters. So third quarter, fourth quarter, and then going into the first quarter of next year. We're not looking for any economic contraction, but definitely looking for that rate of growth to continue continue to slow. Now, as far as the bank earnings themselves, I need to separate that up between the mega banks and the regional banks. From the mega bank point of view, I think earnings are going to look pretty good. I think defaults will be relatively low, charge-offs will remain relatively low, their net interest margins should remain relatively high. So I think the earnings themselves are going to look pretty good. From the regional bank point of view, it's much tougher to tell. So we know that deposit loss had continued over the course of most of the second quarter. So that's going to raise their funding costs as they have to get funding elsewhere and pay more money for it. So that will continue to pressure their earnings. And in fact, amongst the regionals, we do think that their earnings will decline sequentially through the end of this year and beginning of next year as well. But for the most part, we think most of those earnings, or for the most part, the market is over discounting those earnings. We think that a lot of those regional banks are just undervalued at this point. So we do see a lot of opportunity amongst those regionals for investors today.
That's a really interesting point. Doing your due diligence there to separate the big names from some of the regional names as well. That's been a topic of conversation, of course, for many months here in 2023. So it sounds to me as if you believe credit availability and the tightening of that availability will still be an issue for a little bit of time, something you'll be tracking for a while.
Yeah, and again, it's just one of those factors that we're looking at right now as far as why we think the rate of economic growth, will slow over the next couple quarters.
And what could be the potential impact on the market of that tightening of credit availability, you think, Dave?
Well, and a lot of it has to do with just how well the market has done in the first half of this year. Now, coming into the year in our 2023 outlook, based on a composite of our stocks that we cover, we noted we thought the market was about 16% undervalued coming into the year. So, pretty significant discount as far as we're concerned. Now, we are up about 16.5% for the broad market average. So, at this point, we're only a couple percent undervalued. So, a lot of what we expected to happen this year has actually already occurred in the first half. So, I doubt we're going to see anywhere near the same kind of returns in the second half of the year as we have in the first half of the year. But I'm also looking for a shift in the market composition for returns in the second half of the year. So again, growth stocks and specifically, the Magnificent Seven were really predominantly the force that caused the market to rise in the first half. Now, of those seven stocks, six of those sevens were actually undervalued in our view coming into the year. They were either 4-star or 5-star rated. Of those, only one, now Alphabet, is still rated 4 stars. Of those Magnificent Seven, 4 are now rated 3 stars, meaning we think they're trading pretty close to fair value. And 2 of them actually gone too far. Apple and Nvidia, we think, have gone up too much, too fast. We now rate those 2 stars. So again, that driver for the market we think is behind us. We're really looking for returns now in the value category, which we still think is undervalued, as well as in the mid cap and the small cap space, which is where we see the better opportunities today.
Of course, Nvidia, the perceived
Mm-hmm.
leader here for the so-called generative AI revolution. That stock alone up about 200% or so year to date.
Yeah.
The indexes, of course, as you talked about there, Dave, having a really big year so far year to date. The S&P itself is up more than 12%. The tech-heavy Nasdaq, which includes a lot of those Magnificent Seven names, up nearly 30% in the first half of the year. How do you view current market valuations for equities as we move forward into Q3? And before we know it, we'll be having this conversation for Q4. What does it look like for the back half of the calendar year, you think?
Well, we do think that there's still room for the market to rise. I just don't think we're going to see, the same kind of returns that we've already seen. So again, I think at this point, investors need to look at making some reallocations in their portfolio, specifically take profits, in those areas that now are overvalued and overextended, reallocate that into those areas that have lagged behind and remain undervalued. So for example, when I look at our different sector valuations, I'd note technology is now overvalued. It's trading, somewhere between 7 and 10% over our fair value estimates. I think now's a good time to take a lot of profits in that technology space. This is the first time we've seen technology overvalued since the beginning of 2022. And look in some of those, other sectors, like a lot of the cyclical sectors, we think remain undervalued at this point. So again, while we do expect the economy to slow, we don't expect a recession. That's not our base case. I think a lot of the cyclical sectors have gotten pushed down, way too far. Real estate would be one. We think that's trading at about a 17, maybe 15% discount discount from fair value at this point. Financials got beat up pretty hard earlier this year following the failure of Silicon Valley Bank and Credit Suisse. But a lot of those got pushed down, way too far as well. And then we also like a lot of the names in the basic materials sector, especially those lithium names that we think have, just a good long-term secular tailwind behind them.
Do you have a target for where you think the S&P 500 itself will be at the end of the year? Keeping in mind, as we're having this conversation, that index is right about at the 4466 level. And,
Hmm.
according to a lot of analysts out there, it's a big spread, Dave, as you know. Some
Yeah.
people see it going up another 10%. Some people see it dropping another 25, 26,
Hmm.
27% or so. That's a big range in terms of possible outcomes. Where do you see it headed?
Well, we don't really do kind of that price forecasting that you see a lot of other shops do, and we kind of come at it from a different point of view. So we cover about 1,500 stocks globally, of which over 700 trade on the US exchanges. So I really do a bottoms up composite where I measure where those stocks are trading in the marketplace versus what we think the value of those stocks are, what the intrinsic value is. And that's how we come up with this price to fair value metric, which, based even on today's rally, we still think the market's trading at a couple percent discount to fair value. I think there's enough momentum. We probably get the fair value here, relatively quickly. And then once we get the fair value, what that means is then we expect the market to continue to grow at, the average cost of equity about 8.5 to 9%, over the long term from there on out.
Dave, are there any sectors or even maybe any individual equity names that you think maybe you've had a little bit of an
Yeah.
unjustified positive performance so far year to date, I wonder?
You mean ones that we've think have run up too far at this point?
Yeah, absolutely.
Yeah, so technology be, the one that I would highlight the most. And I think people really need to take a deep dive and look into Nvidia. As you mentioned, that stock has had a huge rally this year. Yeah, we agree, very significant tailwinds behind that company, behind that stock. In fact, we bumped up our fair value from $200 to $300 a share. But even then, when I still look at, in order to get to that $300 share, model driven uh, valuation, we're looking at revenue growing by 50% this year. We're looking revenue growing over the next 5 years by 23% compound annual growth rate. We're still looking at a doubling of margins, and we still don't think that that stock is worth where it's trading in the marketplace. So again, that would be one where I think if you've been involved, that was actually an undervalued stock coming into the year, is rated 4 stars, but with as much as it's run, I think now's a great time to take some profit there.
How have big tech or AIs, maybe specifically a name like Nvidia, skewed overall market and stock performance? Obviously, I know it's something
Yeah.
you follow, but help contextualize this for our viewers a little bit more.
Yeah, so again, there's been 7 stocks that have been responsible for, and depending on when you measure it, a couple weeks ago is, over 75% of the market return coming just from those 7 stocks alone. We now have started to see the rally start to broaden out from just those 7, and I think that's good news for the market. Again, I think at this point we're looking for, different areas like the value stocks, to pick up, the torch here for the second half of the year, and as well as to start moving into those names that are in the mid cap and the small cap space where we see the best valuation.
What are the risks to those magnificent seven, so to speak, carrying such weight in the index games? Keeping in mind, however, like you said, it seems like at least some of the names in the Russell, other smaller cap names, have been able to finally join in on the fun as of late.
Yeah, and that's why we're looking at just trying to take profit where it makes sense to take profit, and put that back into some other names. So, for example, you look at how well Meta has done, thus far this year. Again, that stock is up, more than double, maybe 150%, year to date. That's gone from a 5 star down to a 3 star. So I think it's a good time to reevaluate that. Maybe look for other stocks that then will benefit from an increase in digital advertising over the long term. So I know, in our communication sector, our analyst there that covers Alphabet and Meta, has recently been highlighting, Pinterest as a stock that he thinks was kind of maybe the next to move up.
Since you mentioned Meta, I can't help but wonder, and you may not have an answer to this. Does Threads move the needle at all? Since it is one of the new shiny things people are talking about in the last week or so.
And if you go to morningstar.com, you can see our most recent note on that specifically. So we're watching it, we're gauging it, but at this point, we think it's just too early to necessarily move our fair value, based on threads alone. We want to see, not necessarily only what kind of uptake, but what kind of, ongoing engagement there might be there, and then whether or not that can drive, additional advertising revenue for Meta. So at this point, still a little too early to tell.
All right, I do appreciate that. Thanks for letting me throw that one in there. Obviously, when you talk about Meta in the last 7 or 8 days or so, that tends to be top of mind, especially in the Elon Musk versus Mark
Hmm.
Zuckerberg battle conversation. Dave, how should investors be viewing overall tech and growth names within their own portfolio as we move forward in the second half of the year, you think?
Well, and again, I still think that in the tech space, there are a lot of names that have run, too far, too fast. Now's a good opportunity. Hey, the old adage, you never went broke taking a profit. Again, I think now's a good time to be taking a profit in the tech sector overall, as well as in a lot of these names that now have moved into, two-star and one-star territory, and look to move that into where we've seen, the market lag behind in the value category.
And we've hit the overvalued sectors of the markets. How about on a discount basis? Are there any areas, sectors, points of view in the overall
Yeah.
markets that you think maybe kind of stand out to you through the discount lens that some of our viewers may want to take into consideration as they look to readjust parts of their portfolio for the second half of the year?
Yeah, so right now, the most undervalued sector still remains the communication services group. And again, the Meta and the Google, they're over half the market cap of communications, but to some degree, Meta has already run its course and Alphabet doesn't have as much upside as it used to. But we do see a lot of value in the communications and a lot of those traditional names, thinking about, AT&T and Verizon are two stocks that we think are significantly undervalued. We see much better, growth for those stocks, specifically looking for better margin performance, in the future. So when we look specifically at the wireless sector, it's really going to be much more of an oligopoly going forward. So you really have those three main competitors between AT&T, Verizon, and T-Mobile, and we don't think that they're going to go through the price wars like what we've seen in the past. So we think that's going to be a benefit there. Warner Brothers Discovery is another one, more of a traditional name that we think is undervalued. We still see a lot of synergies that will come through between the merger between Warner Brothers and Discovery. So that'd be another name in that sector that I would highlight.
Absolutely, and I appreciate the specifics there. Finally, Dave, if you don't mind me asking, is there anything in this overall conversation you think maybe we're not paying close enough attention to? I'm sure you've closely followed the world of business news. You hear a lot of the same conversations going around. Is there anything that kind of keeps you up at night that said, man, I wish people paid a little more attention to this? What would that thing be if there is such a thing?
Well, if we're looking for new ideas, I really like still in the second half of the year focusing on a lot of the different themes, especially those with long-term secular tailwinds behind us. So thinking about like the electric vehicle market, there's a lot of different ways to play that, which are more second derivative plays that we think have a lot more room to run. Like in the lithium names, we think lithium's going to be undersupplied over the next decade. So a name like Albemarle would be one that we currently rate 4 stars, trades at over 30% discount to fair value, or even some of the specialty chemicals, makers like a Celanese. And I think it's interesting that it takes anywhere from 2.5 to 3 times as many specialty chemicals to make an electric vehicle as it does an internal combustion engine vehicle. So that's a stock that we think has some good tailwinds behind it as well. Thinking about like consumer behavior normalization, a lot of different ways to play that. People going back out in public more often, going now about to different types of events, traveling more. So like a name like Carnival, even though that's had a pretty good run, we still see that as being significantly undervalued at this point. In the gaming sector, Caesars Entertainment will continue to keep benefiting from additional foot traffic. A lot of the retail malls also will benefit from that retail traffic, coming back to the stores. Simon Property Group and Macerich would be two that I would highlight there. And then some other areas like in medtech. Again, that's another space where I still think there's a number of different opportunities. We had United Healthcare recently, talk about increases in demand that they've seen for healthcare services. So a lot of those procedures that I think were delayed during the pandemic are now coming to fruition. So companies like Medtronic, it's a 4-star rated stock, trades well over a 20% discount to fair value, also pays a nice dividend yield, would be the one I would highlight there, as well as Zimmer Biomet. So again, really sticking with more of those long-term secular themes in the second half of the year, I think will play out for investors more than necessarily trying to trade, the broad category or broad sectors.
Dave Sekera is the chief U.S. market strategist at Morningstar. Dave, my thanks to you for taking the time. Outstanding context, and I appreciate you joining us here at Public today.
Well, thank you. I appreciate it. Time.